we're living in a very dynamic time, particularly with the impact of AI, and maybe you get a little bit AI fatigue, and we're talking about it from a systems perspective and all these sort of things. But one of the angles that we need to be thinking about as well is what does it mean from a talent and from a team perspective, and then how does that actually flow through to what we're going to talk today is around the equity incentive side. Bit of an introduction to Cake, if you don't know who we are and what we do. We've been around for about 5 years. We the dominant cap table provider and in Australia, so really helping founders manage everything to do with their cap tables and startup equity, from capital raising to the equity incentives to communication, etc. The piece that we're super passionate about is helping founders unlock the power of team motivation via the equity incentives. And we know that one of the most meaningful parts of the startup journey can be sharing the rewards of creating wealth with your startup teams. And I've heard people like Luke from Culture Amp talk about that as a founder, and the journey that the early stage employees in particular go on with you as founders as you're actually building your business, and how satisfying it is to be able to actually share the rewards in getting to that unicorn status with the team members. And I think one of the things that we'll explore a little bit more today is, we're entering a world with AI where, the individual scale is going to be greater over time, so getting the right people on board is going to become even more important going forward. So in terms of Cake itself, so as I said, we started 5 years ago. We started doing early stage startups. We now do right through to sort of later stage startups like Linktree and M&U and Mr. Yum, etc. here in Australia. We've been in the US for about 3 years, so that's our biggest market now. And we help a lot of Aussie companies who are either going to market in the US or hiring employees in the US, or even flipping up to the US, which is part of the journey that we've been on ourselves as well. I'm really pleased to be joined by Shak from LegalVision and also Tila from Cake here today. So, Shak, do you want to give a bit of an overview of LegalVision?
Yeah, thanks, Cal. Thanks for having me, Taylor and Cal. So yeah, my name's Shak. I'm one of the lawyers here at LegalVision. I'm in our corporate transactions team. So LegalVision, quick introduction, we're a full service commercial law firm. We have a range of practice areas, for example, employment, franchising, commercial contracts, general corporate. We assist with capital raising, franchising, disputes as well. And I guess one thing that we do really well is that we provide legal services through a kind of a membership model, a subscription model.
One of the things that I always say to founders at any stage is one of the most important things you can do to ensure your success is make sure you've got the right tools to help you and your team, and I think that's where Cake comes into it. But also making sure that you've got the right people advising you as you go through that journey, and people that are going to be absolutely critical for that, who are the right legal partners that I've got that actually know what they're doing in the startup space and have a real track record and expertise in helping out, and helping you navigate all the uniqueness that is everything to do with startup equity and startup legal matters like IP and all those other things. So yeah, it's great to have someone like you on the call today. So just in terms of what we'll run through today, let's spend a little bit of time talking about, equity incentives, and then also talking about AI impact on startup teams, and also the talent bit and the ESOP bit. We're going to Shaq will take you through setting up an equity incentive plan and some of the core fundamentals around that. I'll talk a little bit about how you can use the Cake platform to supercharge your ESOP and some of the key elements of that. And then we'll take questions at the end. As I said, please don't hold back. If you have questions as we go through, drop them into the chat. If I don't see them or Shaq doesn't see them, Taylor will let us know. And then we can just make it as interactive as possible. I think I've skipped ahead there. Let me go back a bit. Okay. So as I said earlier on, like one of the things that we're really passionate about and mission is an important mission for us is unlocking the motivational power of equity incentives. And, we really do believe that getting the right team on board is the most critical factor in startup success. And as I said earlier on, I think what we're seeing with AI tools being able to actually scale the individual impact, that's becoming even more important as we go into the next decade. It's not just something that we kind of believe ourselves, but I spend a lot of time in the US, and The venture investing community in the US started in the 1950s post World War II, right? That's how early it actually started. And so over there, you actually see a startup ecosystem that's in the fifth or sixth turn of the flywheel, right? And if you look at entities like PayPal and you've all heard of the term called PayPal Mafia, and you look at the group of individuals who are actually in that business and built that business, and then the things that they've gone on to actually do afterwards, like YouTube and like LinkedIn, Reid Hoffman doing LinkedIn, obviously Elon doing SpaceX and Tesla, etc. You can see this, not only is it important in terms of rewarding people, but it's also really important in terms of creating the next generation of startup success. So those people who are actually part of your team that hopefully have that mini founder mindset, because they do have an ownership stake, are then going on and not only investing their talent in the next generation of startups, but they're also taking some of the financial gains out of that to be able to actually do that. And you can see that in the Australian ecosystem. People like, Skip Capital and that, which are actually, coming out of Atlassian and reinvesting, but then also individuals like Ross Chilcott from Kind, who used to work at Atlassian, Christian from Index Ventures, who used to work at Canva, coming out and actually starting their own startup. So it's really important, this sort of ownership mentality and ownership mindset, but also that wealth creation to building the ecosystem as well. But there are some challenges, like, while people, the employees, uh, tell us that equity is an important factor in them accepting roles and looking at the offers that are available. We know that there is a gap in terms of their understanding of how these things work, right? And so, while I would say in the case of investors, you have this asymmetry where most investors, particularly if they're a venture investor, know much more about investing than the founders do. When it comes to the employee equity side, it can be very much the other way around, where the founder may know what they're doing, but don't assume just because you know how these things work that your team understand how they work. And if they don't understand how they work, then they can't really identify with the value that's been created for them over time through the equity incentives. And, just to give you an understanding of how much value that could be over time, the median option pool for companies, with $10 million valuation is 13%, right? And then by the time you get to $1 billion valuation, that median option pool size moves up to 20%. So if I might, let's say I'm really successful and I get to a valuation, say on par with someone like a Culture Amp, that might be like, $4 or $5 billion. If I get a $5 billion valuation, $1 billion of that is going to be allocated to my team. At that point, they're probably your largest single stakeholder group in the whole company. There's probably no individual investor that has more than that. So it's not only important from a motivation perspective, but it's also very important in terms of the amount of value giving away. Tila, can you launch that poll and just get a bit of feedback from you guys in terms of some of the impacts that you're seeing and anticipating in terms of AI? So
We've got a question in the chat as well, Cal, from Claudia, looking for examples beyond recruitment and talent attraction for incentives and equity. So that might be something you maybe touch on later on, or
yeah, so how are we going and attracting and retaining AI native talent? So by AI native, I guess I'm looking at, regardless, they don't necessarily need to be, machine learning engineer or someone who's just focused on the AI space, but certainly someone that whatever role they're in the organisation is actually using AI extensively in that role to be able to scale up what they're doing. It could be a marketing role or it could be engineering. So yeah. So just on the first couple of questions, so as I said, the first one, from a cake perspective, I would definitely say high impact in terms of our business, and pretty much everybody across the business is spending a significant amount of time upskilling around AI tools that we actually use and looking at how we can implement it across all the different parts of the business. So not just from a coding or a development perspective, but right across the board. Yeah, so that would definitely be the case. And then in terms of the second question, so there was a bit of a mix and some people are not still working out how it's going to impact. Certainly for us in the near term, we would see it as an opportunity to actually, we're not looking to cut the number of people we've got or anything like that, but certainly as an opportunity to increase the productivity of everybody across the business, and therefore looking at being able to do more with the same amount of people, really increasing the productivity, increasing our average revenue per FTE as well. So we'd expect to actually continue to grow that in a meaningful way without having to actually add the same number of people that we might have had to do before we had AI tools available to us. Tilo, have you got the results of that poll? Are you able to share them?
Using early stage equity and aligning with mission aligned engineers while building the team. Not specifically looking for that at the moment. Everyone has to be AI native talent. Probably not going to have any special treatment. It would be the same strategy, but those who are not, they might have to eventually go. Haven't had an issue yet. More looking at the curiosity around AI, so looking for those signals and applying that in the working environment because everything's so new. Haven't needed it yet. Self-taught in that space with difficulty. Everyone is an AI expert now, and finding those who actually really understand it is the challenge.
So thanks for sharing your perspectives there, and Matt, thanks for sharing in the chat. So please feel free to continue adding your thoughts on this. But we are definitely seeing, what we're doing from Cake perspective, it having a significant impact. And we're a SaaS business, so it may be different in different business models, but we are definitely seeing it have a significant impact in terms of our productivity and our ability to be able to really automate and scale. Our business, we're product led, which means that from day one, we've been built into our DNA is look at how do we actually scale everything that we do. And so an example of that for our business is that 70% of our paying users onboard themselves without having to actually talk to a salesperson. So it's not something we have to go out and actively sell. We have a free version of Cake, and then people get value out of it, and then they upgrade to paying as they go through. But to provide you with some broader context, here's some of the stats here that we're seeing across the broader market. So one of the things we saw in terms of 2024 is we saw a massive shift in terms of funding towards AI native startups. And what we saw in terms of those funding flows in particular is a very big chunk of the funding, that 46% of US VC funding that went into AI went into some of the larger foundation model LLMs and those sort of players there as well. So if you look at VC funding stats overall, they actually look pretty healthy in terms of the dollar volumes that have actually gone into startups, and that lifted through 2024. But if you dig beneath that and you look at the percentage of it that's going into non-AI native startups, there's been quite a significant contraction in that. So it's something that certainly you need to be aware of, and we are seeing that resulting in some funding challenges. It is potential that 2025 may be different in terms of just the scale of some of those larger fundraising rounds, some of the big players there, because there was some big hundreds of billions of dollars that were raised by some of those guys. But so it could come back as a percentage a little bit, but I think the ongoing trend that there's going to be a significant portion of VC funding is going to be allocated to AI native startups. So that's something to be actually considering. Offsetting that is you do have the ability by leveraging these tools is to be able to do more with less. So, there are also things like this, seed strapping and some other terminologies that are coming in from a funding perspective where people are looking to raise a reasonable first round and then being able to actually get a lot more traction and then potentially even skipping a seed round. And by the time they do their next raise, they've got more like Series A funding round metrics. We are certainly seeing a premium for AI talent, and you're seeing that in engineering roles. So, the latest stats there, machine learning engineers versus a normal software engineering role are getting a 20% premium in terms of the salaries, and then even more in terms of the equity compensation they're getting. And then, you also get like these stories about, Sam Altman talking about, the very top 1% of talent that are working on these foundational models and LLMs and the infrastructure layers of them getting, offered $100 million or whatever. Well, that's not the reality of probably where most of us are actually competing, but there is some element of that where certainly, even if you go outside the engineering role, people who are AI natives, whether they be in a marketing or a sales role or whatever, being able to actually apply those roles and to be able to scale the impact of those roles are likely to continue to attract premium over people who don't, which was reflected in some of the comments early in the poll there as well. We have seen a trend since 2021, 2022, which was the kind of the bubble in terms of VC funding, that we have seen this trend towards two things. So one is smaller team size. So the median team size at Series A has come down by 22% since 2020. And so certainly with AI, we expect that to continue to be the case. And then offsetting that, you're seeing, well, maybe as a result of that as well, playing into that is the fact that you've seen an increase in revenue per FTE over that period of time as well. Revenue or ARR per FTE, you continue to see that one. And then, so what does that mean? What does that mean for ESOP, and what does that mean for salary? So one of the things that we're seeing, and you see it reflected in terms of some of the more, the AI-based engineering roles or the machine learning-based engineering roles, is yes, we're seeing a premium in terms of the salary side for those roles, but we're seeing even a bigger difference in terms of the equity compensation between a normal software engineer and a machine learning software engineer. So I expect that will continue to be the case. And then as you actually are able to get more traction earlier on with a smaller team, one of the implications of that is I think we'll actually see it being more important to have your ESOP set up early, because you're not having to wait until you get to a team of 5 or 10 people before you put your ESOP in place. Because with a team of 3 or 4 people or even 5 people, you're actually able to get quite a significant amount of traction, and therefore making sure you've got these things in place set up properly, so you've got the right talent coming in, but you're also retaining that talent is going to be important. So getting these things set up early is going to be important. Smaller team with higher revenue per FTE. Sorry about the spelling mistake. What does that mean in terms of the option pool size? That could go two ways. You could actually see the option pools shrink. So typically we start with a 10% option pool. As I said, the median option pool for a 10 mil valuation company is 13%, but the typical starting point is 10%. You could see that shrink, but my hypothesis is that you'll actually see greater grant amounts with less people. So the option pool size is likely to remain similar, or it could even increase over time, depending on the type of talent you're actually looking to get in. But what you'll end up with is a larger grants over a smaller number of people. So that's one of the hypotheses that around option grants. And then the last one is, certainly if you are looking to attract specific AI talent to your business, one of the things you might need to consider is being more flexible about some of the vesting options that you actually, and the way that you're doing the grants for those individuals, particularly if you're looking to attract the very top talent in those pools. And Shaq will talk a little bit more about the typical vesting schedules and everything later on, but you might need to be a bit creative and move away from the industry standards, which is typically 4-year time-based vesting with 12-month cliff, if you want to attract the top talent to your organization. So I don't know if anyone's got any thoughts on that, or Shaq, if you've got any perspectives from a LegalVision or anything to add, I'd love to hear it before we move on.
No, look, I agree with everything you said. I think the ESOP and equities generally is a fantastic, attraction mechanism, but it's also a good retention mechanism. And this goes to the question that was asked earlier. I think it's just the way you frame it to your employees, your advisors, even your contractors and your directors as well. I will get into this later, as Cal mentioned, but essentially, the more buy-in you get from an employee, theoretically, the more their productivity increases, and the more skin they have in the game, the more it's on the line for them. So the more, I guess, from what we see in practice, the more effort they put in, because later down the line, the more they'll get out of it, right? So that old adage of the more you put in, the more you get out of it, that's very much the case here with ESOPs and equity generally.
Cool. Okay. And now over to you, Shaq, to talk about how these things work.
Yeah, so stock options, here in Australia, in America, they're more commonly referred to as stock options, but here in Australia, they're simply just options. I think this is a segment that Cal and I really wanted to touch on, because, as Cal mentioned earlier, whilst you may understand how an ESOP works and how the equity works in your business, being able to then explain that to your employees is a very important part, because if you're not framing it in the best way possible, or if you're not explaining it in a way that your employee can understand it, then again, you won't get that buy-in. You won't be able to use it as a motivation tool and ultimately as a retention tool as well. So yeah, when to set up a stock option plan, as Cal said, the earlier the better. When you set up an ESOP, which is an employee share option plan, but it's just easier to say ESOP. So with an ESOP, it's a very easy setup process, especially if you're setting it up near the beginning of your startup's life cycle. So for example, if you have a company you've just set up, it's just yourself as director, you're the sole shareholder as well, or you have a business partner and it's just the two of you, you would really only need the two of you to approve the implementation of the ESOP. And in terms of documentation, if you're happy to have a chat with us, we're more than happy to set up your ESOP documents as well. So it's very easy to set up. And because you've set it up, once you've set it up, it doesn't mean you have to use it. It can sit in the background until you're ready to actually make offers to prospective employees later down the line. And yeah, in terms of this timeline, really it's just an indicative timeline. There's no set time when you have to make your first offer. There's no set time where you have to grow your pool. Really, it depends on the company's circumstances from time to time. So for example, you may set it up with 5%. You may go to your first funding round after 12 months, and you may wish to top it up to a total 10% pool at that time. Once you get to Series A, 3, 4, 5 years later down the line, again, you may wish to top it up to 15% because, depending on how many employees you have at the time, it's a very flexible process. Yeah, how options work. So I think it's really key for everyone, not employees, founders alike, to understand how the option actually works. So the option is a right to acquire a share in the future, and in most cases, certain conditions need to be met in order for that option to convert into a share. So the other key concepts, I'll get into kind of the difference between option versus a share later on, because that's a very key distinction we think that needs to be addressed. So vesting is a concept where the employee can earn the value in their options over time or based on milestones. Again, another topic that we'll get onto later. Strike price is the strike price or exercise price. Those are two different terms, but they mean the same thing. So essentially, where the option is being converted into a share by the employee, they'll need to pay a predetermined strike price. And usually the ESOP comes with tax benefits that then passes on major benefits to the employee in terms of the strike price. Again, something we can touch on a little bit later. Exercise. So yeah, exercise is when the option converts into a share at a later time. And there are two main processes. You can set conditions on which the employees can exercise their options, so that firstly, either the company needs to achieve a certain milestone, like potentially selling the business, or the employee needs to achieve their predetermined vesting conditions before they exercise into a share.
And just to correct on this one, I've got in there set your exercise or strike price via 409A valuation. If you've got a US employee, you will do that. If you're in Australia and you're relying on the startup concessions, you'll generally use an NTA valuation to be able to do that. So that applies to US employees, but for Australian employees, it's generally a simpler exercise where you can just use an NTA valuation, which is usually comes up with a very nominal price for the exercise.
So yeah, look, I've kind of covered a lot of what options mean, but in terms of what they actually mean in practice. So yeah, option, you're acquiring a share at a later time. So it actually means your employee you can give options under the ESOP to employees, contractors, advisors, directors as well. It's just anyone who is providing services to your company or is employed by your company. They're the eligible persons for your ESOP. So when you're giving them an option, they don't have a right to vote in the company's matters. They don't have a right to receive dividends, and they don't have a right to claim surplus assets on winding up until those options are converted into shares. So from a company's point of view, from your point of view as a founder, it's very helpful in that you can give your participants some skin in the game, but they don't get involved in the day-to-day operations of the business. So you can continue running your business and maintain control on a day-to-day basis, but still give them some benefit in the short and long term, provided the company is growing through the employee's contribution. One of the key things with options as well is that they're very, very easy to buy back and cancel once your employee leaves, if they leave. So this is very different to shares, which I'll also touch upon in a minute. But essentially, if you're buying back options and cancelling them from your employee, once documents to do that are signed, they're done, they're bought back, they're cancelled. No other lodgements need to be made, no other notifications need to be made. And with options, if you set up an ESOP here in Australia, there is a concept of the ESOP startup tax concessions. So there's a number of criteria. I think there are about 10 that are relatively easy to meet for a startup. And once those are met, it offers really very favorable tax incentives to the employees. And it also allows the company to set terms of the ESOP that are favorable to employees. So the whole concept around the tax concessions is towards employee incentives and ultimately retention as well. But yeah, and in terms of quickly just talking to some of the one of the main benefits is, as Cal touched upon, if the tax concessions apply to your ESOP and your offer, you can then use an alternative valuation method to set that strike price, being the net tangible assets test. And for an AI-focused company, it's very likely that strike price will be very low as 1 cent per option, because AI-focused companies, in most cases, will be low on tangible physical assets, which is what this NTA test really looks at.
And just to give you an idea of from a tax perspective, like how meaningful it can be, right? So, I used to work in large public companies, and I got equity incentives as part of that. But generally, if you're getting equity incentives, they get treated as income, and they're assessable when the option is actually given to you. So, I had scenarios where there were triggers before those options could vest, right? And they're performance-based triggers. So whether you get to them or not at the end of the day, is open, it depends on your company performance, but it also depends on your peer performance as well. And so you can be in a circumstance where you having to actually pay effectively income tax on equity incentives to give to me today, which may never actually have any value at the end of the day. Now, that can still be the scenario for startup options, but generally with the startup concessions is you don't have to pay anything until you actually sell the shares in most cases and actually realize a gain from them. And that might be 10 or 15 years down the track, right? So it can be very beneficial. And Shaq mentioned, some of the criteria, they're not particularly onerous criteria for most people. They're things like, your organisation needs to be less than 10 years old. There are some turnover threshold questions. There's some limits on the amount of equity you can give any one participant. I think it's 20%. So there's a few rules around them, but for most startups, they're relatively easy to meet those, and it is extremely tax effective from the employee's perspective, and then, but also, for advisors and contractors, if you're wanting to incentivize them with that structure as opposed to paying them a salary or which is treated as income, it can be really tax effective.
Yeah, and just going back to the comparison, just quickly touching upon shares. So shares, once you give a share to an employee, they become a part owner of the company from day one. They have the right to vote on shareholder matters. They have the right to receive dividends and claim surplus assets when winding up. So if you choose to go down giving them shares from day one, you will then have to deal with your employees when it goes to when shareholder matters come up. And that does get a little bit onerous, especially if you're wanting to firstly maintain control and move quickly in your business operations, which most startups will want to be doing. You don't have to wrangle, potentially 20 employees to say, hey, can you guys give me an answer on yes or no on this particular matter? Whereas the option, you don't have to consult employees on shareholder matters. You don't have to consult employees on a day-to-day basis outside of their employment roles. And again, going back to that key difference. So with shares, once the holder of the shares leaves, and let's say you want to buy back those shares, the process takes around a month, and there are strict ASIC timelines that you need to follow. So it's not a quick, employee's been terminated or they've resigned, we want to wrap this up in the next week. It takes about a month at a very minimum to wrap that process up, whereas options, you can, move on from that relationship, good or bad, very, very quickly. And if you do set up an employee share scheme, which is an employee share option plan, but with shares and not options, there are startup tax concessions that do apply. However, they're a little bit less favorable from the employee's point of view, because while the options, you can use that net tangible assets test, which may result in a very, very low exercise price or strike price, the tax concessions that apply to a share scheme is that the 85% of fair market value is the minimum you can go in terms of that strike price that they would need to pay for the shares under a share scheme. So already if you're going down the share route, it's already a little bit less favorable to employees. If your fair market value for a share is $1, they have to be paying at least 85 cents per share, whereas for options, they could be paying 1 cent per share.
Yeah, great.
And so I guess, key takeaway, I've kind of been going on about it through my segment. Yeah, it's very favorable for companies. There are a lot of administrative and operational benefits to setting up an ESOP. And, in our view, you can talk to any of the LegalVision lawyers. We'll say, let's set up an ESOP because with the employees, even if they don't receive a share, they may receive some sort of financial payment as a result of how many vested options they have at the time. And, depending on how much they put in and how much they help the company grow, the more they get out of it. The higher the share price is, essentially, the higher the option price is, the more financial payout they may receive. And ultimately, if you have an employee that you've taken on very early, which was the case with Canva recently, I think it was at the end of last year or maybe mid last year, Canva did I think they did a secondary sale where a lot of those early employees had their shares bought out. And I think their returns were, hundreds of thousands of dollars because, they started early. They helped the company grow throughout that entire time. They put everything into it and they realized that value at the end because of how much. Yeah, exactly. Yeah. I think I might have understated how much some may have got. But you can really see that with the options, administratively, you don't have to deal with your employees, as bad as it sounds. You don't have to deal with them on a day-to-day basis. But for them, there's kind of the carrot on the stick at the end of the tunnel that the more I put into this, the more value this company will have and the more I'll get out of it later on.
Yep. Claudia asked a good question. Company, they're in the middle of setting up an ESOP. They're nearly at the 10-year mark. So just asking about where they can rely on the startup concessions. I think you'd probably need to maybe take that one offline and get some advice around that, Claudia. But one thing, Taylor, you might be able to drop this link in the chat. But we had a discussion with William Buck. We did a webinar with them earlier in the year, and that was all around what are the different types of incentives you could use once you're no longer eligible for the startup concessions. So maybe, Taylor, if you could drop that link in here, Claudia, you can have a look at that because that'll run you through some of the options that are available for you. So it doesn't mean that if you're not available for the startup concessions, it's not worth doing it. Well, it's just that there are there's different scenarios that you want to be doing at that stage. So yeah.
Yeah, there are various types of incentive plans that you could implement. And just quickly, with the 10-year rule, once you get to that up to the 10-year mark, you can still qualify. So, for example, I've seen a startup who they had probably 2 months left on the 10-year mark. And essentially you need to make all of your offers before the end of the 10-year mark to qualify. So they were a little bit, they put through a lot of offers in a short period of time to try and meet that mark. So, but yeah, as Cal said, it's probably something you take offline and have a chat with your counsel that's helping you with that one.
Once you decide to implement it, it is pretty easy to be able to do it, and we'll be able to show you through some of that in a little while. Do you want to talk a little bit about vesting, Jack?
Yeah, so there are, I guess, as Cal mentioned, there are a set of, I guess, industry or market standard terms that you can set for your ESOP. So between 10 and 15% for the total pool size, but ultimately that's just the guide. Look, personally, I've never seen anything above 20%. I have seen up to 20%. But ultimately, it's how much the company and the founders want to set aside for their employees. With vesting, as Cal mentioned, the standard is a 4-year total with a 1-year cliff. And essentially what that means is, the options that the employee holds will vest over 4 years. But for the first year, they don't have any options vest in them. At the end of that first year, 25% of the options they hold will vest, and then it will vest on a quarterly basis for the remaining 3 years. Everyone's included. Yeah. So anyone who's providing services or is employed by the company is eligible. And in terms of fair terms, yeah, there are a set of market standard terms that everyone is across. So if you talk to, probably 90% of lawyers, 90% of accountants, most will say the same thing in terms of what the norms are and how it works.
So by terms, we're talking about things like, what happens when under different scenarios when you leave. So for example, if I'd committed fraud or something like that and I left, I don't get to retain my options. If you leave on good terms, then you generally do. So there's all of those terms that are actually outlined within your plan rules that are important for you to understand as a founder, but then also your team to understand as well.
Yeah, and so it's actually setting it up. So as Cal just mentioned, there is the main document is called the plan rules. So this is the plan rules. It governs the powers of the directors of the company to firstly make offers of options under the ESOP, what terms may be set in relation to those offers, for example, vesting conditions, the exercise condition as well. As Cal said, what happens when an employee leaves? It's really important, and the plan rules really has to deal with that. Whether they're leaving under good circumstances, whether they're leaving under bad circumstances, what's considered a bad circumstance. So, for example, the normal set of bad circumstances is fraud, misconduct. An employee's been found guilty of in a court, for example. That's a common one. And what happens to the options if the company's about to sell? Because they can't just be left there post-sale. So, some common examples is if the company's about to sell the business, then either all of the options held, all the outstanding options held by employees vest, and they either get to exercise them and participate in that sale as a shareholder, or the company buys back all of those vested options for the market value of the option at the time of the sale. And yeah, we've touched upon the 10-year rule. So with an ESOP, best to set it up, as early as possible. And again, you don't need to use it. It's like with the ESOP pool, right? If you have a 20% pool, you don't have to use that entire pool. You could get to 10% and say, okay, we're done. We're not going to offer anything, even though we have 10% remaining. It's like an ESOP. You set it up, you don't have to offer. You may never use it, but it's good to have because it allows you to take quick action when you're trying to bring on a key member. So, for example, recently I had an example where one of our clients wanted to set up an ESOP to attract a key person that they wanted to bring on. But, I think it took a lot longer than it usually would take. And because it wasn't already set up, they needed to go to the shareholders and get approval. And it took a long time. And eventually they actually got very close to losing that key person. So the earlier you set it up, probably the better. It may be a bit of a cost at the start to set it up. At least it's there and you can move pretty quickly when it is set up to make that offer.
Yeah, I think the other thing I would say is most sort of institutional investors, most VCs, if they're coming in at a seed stage and you haven't already allocated a pool for ESOP, they'll want you to do that. Some of the accelerator programs like Antler, for example, will want you to do it from day one. I think Antler get you to set up a 12.5% option pool from day one. And the reason why they do that is because if as a VC, I invest in you and then you set up an ESOP pool after that, then that's going to dilute me, right? So I want that, I know that you're going to need that to attract and retain talent. I want that done before I'm putting my check in. So, it's usually just a matter of time, and actually getting it done properly early on is the way to go.
Yeah, no. So these are just a few guides of what we think are standard in the current market. But again, the vesting conditions for the ESOP ultimately go towards incentivizing the employee to either reach certain milestones or stay on for a certain period of time. And with time-based vesting, the longer they stay on, the simple principle is the more vested shares they'll have, the more financial payout they'll have at the end, and the more the more shares they'll receive if they have the more vested options that they have. As with milestone-based vesting, this is actually one of the key concepts we'll come on to later. You can actually tie vesting to certain milestones that are agreed with the relevant, employee or contractor. So one common one we see is revenue milestones. Once the company hits a certain monthly recurring revenue, then a certain, 25% of the options vest in that certain employee. Or if they make, X number of sales during the year, or if, with an AI company, once you develop an MVP, that's actually quite a common one. Once an MVP is developed, then 50% of the options will vest in the relevant employee. But yeah, ultimately, you don't want to be giving too much away to employees, but it is very, very flexible. And really, it's hard to say, you need to give X% to this person. It really does depend on circumstances, but this is ultimately just a guide.
Jack, the question from Patrick in the chat, is it common for a founder who joins? Yeah, so I'm assuming that's a year after formation to take on ESOPs on top of an equity agreement. Yeah.
Yeah, I mean,
So I think,
there's no restriction on founders. Like, a founder can have options on top of shares they already own. So it's a very common arrangement where, you have a founder who comes on board a year in, they get, let's just say, 10% of the company. And then they also want some options which are tied to vesting conditions, like milestone vesting conditions, to further incentivize them. I guess one key thing to take into account is those startup tax concessions. So if the offer is to qualify under the concessions, if the person receiving the options already holds over 10%, they can't also rely on the concessions. So for a lot of founders who hold, for example, 20, 30, 40, 50%, they come to us and they say, hey, I want to give myself options on the ESOP as well. Generally, because of that one criteria, they can also hold options, but it won't qualify for the tax concessions and they won't benefit from those tax concessions. But as Cal and I were saying earlier, there are a range of alternative incentive schemes for founders. It's just a matter of exploring those and determining which one is the right one. And a lot of it is a tax-driven process. So, yeah, so 9%. Yeah, so in that situation, you could have a 1% worth of options issued to the founder and still qualify under the tax concessions. There's absolutely no restriction on that.
Cool.
And yeah, in terms of the, I might just answer the question. Yeah, so with the 10-year rule, it relates to any company in the corporate group, and there's no activity criteria. So it is simply how old the company is, and it's a very strict, literally, if they are more than 10 years old. If there's one company out of 3 in the corporate group that's over 10 years old, then the other 2 companies cannot rely on the startup tax concessions.
So you wouldn't want to be using a dormant company that you've had set up for 5 years ago and haven't been using for it, because then it reduces the amount of time that you can rely on the concessions.
Yeah. And so with this slide, I think, so Cal and I just wanted to point out FAST agreement, so founder advisor standard template. This is essentially an advisor agreement where the company gives it to an advisor it wants to bring on, and it essentially touches upon the advisor advising the company on certain, operations day to day and various things. It's a very standardized template. And you can use it. It is actually quite widely used. And the good thing about it actually is it does provide a guide for, okay, what does the advisor have to do, and how many options, or how much ownership worth of options you should be giving them. Again, it's just a guide, but it is a good guide, and a lot of people do follow the depending on the stage of the company here.
I just to give you some examples. So we, not long after I started at Cake, like pretty much all of our revenue when I started was from legal services. So we had our own in-house legal business shack at that point. We pivoted to just do the SaaS. So our revenue went back to 0 overnight. But we had a key advisor that was really helping us make that pivot and make that decision. He got equity incentives. So, that was Dean McAvoy, who's based in Sydney. Since then, we've used equity incentives for like advisors who have helped us with our go-to-market in the US. We actually had some advocates who had really strong networks in the US market who we were able to actually bring on board. There's no way we could afford to have them working as a full-time employee or pay them cash. But by using equity incentives, we're able to actually get them on board, really accelerated our learning in the US market, but also our access into the startup networks over there, which are really important in terms of our go-to-market success over there. So these are really flexible as well. So I would really urge you, they've been really important in terms of our success over the years. So don't just think about it for employees, also think about these for key advisors as you go through that process as well. Okay, so I'll just go into, I want to just switch over now, and I'll just show you some of the tools that we have in the Cake platform to really help you manage through the whole process of setting up your ESOP, and then also your managing it on an ongoing basis, and then really unlocking that motivation element with your team. So can you see, everyone see what I'm sharing there? So this is just like the cap table view of in Cake. So this is a demo company in Cake. But what I'll do is I'll just take you through the process of actually setting you up and show you what it looks like. So if I come down here to options here, one of the things that we do with the platform is we default to what is the standard industry practice or best practice on everything that we're doing here. So I've actually got a previous ESOP pool set up here, but let's assume that you don't have one set up already. Then I'd come in here and I'd set up a new option pool. And what you can see is we default to 10% pool, which is typically what we see as 95% of startups doing the option pool for the first time will actually set up a 10% option pool, and that'll be converted into ordinary shares. Now, if you want to change that, you can change the amount here. You can change, what it's converting into and all those sort of things. But what we do is we default to the standard here to make it easier for you to navigate through this. Now, if we go to the next step here, okay, so what I've done here is I've gone in and created that option pool here. So one of the things here is we've got a lot of educational information in here for you to help navigate through it. But as you actually come in here, one of the things you'll see here is this contracts piece here. So what you'll be able to do is upload the plan rules and also upload your offer letters in here. And what that means is every time you set up to do a new option grant in the platform, you can use the templates that are here. So if you're using Shaq and his team to be able to give you the advice around setting up your ESOP documentation, what you do is you upload their plan rules, you upload their grant letters templates in here, so that every time I do a new offer, it'll just populate the details of who it's going to, the details for that specific grant, but it'll use their template docs to be able to generate that offer. And then you can use the Cake platform to do the sending and signing on that. So it really streamlines that whole process around doing that. And so if I go in here and I look at an existing pool that we've got set up here, where we already have doc templates in here, and if I add a new offer in here, again, it'll default to what is the standard. So you can see here, we've got, 4-year time-based vesting with a 12-month cliff. In this case, this company has employees in the US and Australia, but I'm actually doing it to an Australian employee in this example. Let's say I'm happy with the number of options that I've got here. Vesting start date, I might want to start that tomorrow. And then I'm just going to do the standard vesting. But if I want to change that, let's say they'd already been with me for 12 months and I'm a bit slow, I can change that to, no cliff. And then it's just doing it over 3 years, or I can add milestones in there or whatever I want with that. I then put in my exercise price. Let's say it's a nominal exercise price. So let's say it's 5 cents. And then at that point, I can send that offer. In this case here, I'll just save a draft and I'll show you what has been generated off the back of that. So, sorry, I've got to select an option holder. And then you can see here, I've got the offer that I just created. Should be that one there. And that's actually ready to go. And then if I go in here and have a look at the individual offer, so what I'll have is it's got all the vesting in here, so you can see that, but it's also generated these plan rules, and it's also generated your offer letter as well. So your offer letter here will have all the information for that grant. So it'll have how many options, the cost of the options, how long the vesting period is, the exercise period, and all that sort of stuff has been auto-populated into these doc templates. So as I said, you take the LegalVision templates, you'd upload them in here, and then every time you have a new employee you want to grant an option for, you're able to do that. Now, some of the other things that will really help you as you go through this process, we have a equity benchmark tool in here as well. So what that'll allow you to do is if you go in and you select a role, let's say we're looking at an engineering role, and let's say it's a mid-level role, and your company is at seed stage, then There are over 250,000 equity grants in the Cake platform. So it'll go through and give you the data that we've got in terms of the grants on the platform, and it'll give you a median amount that is being granted for someone in that role at your stage, and it'll also give you a range. Now, if you happen to pick some obscure role that we don't have a lot of data on, it'll actually tell you that. But it's a great tool for you to be able to get another data point for working out how much you want to give the individuals as you go through that process. And that's in there as well. So once you generate that offer, you can send that out via the Cake platform, and it'll allow you to get an email notification to your team member. Not only will they get the ability to be able to execute that offer online, but they will also have the ability to be able to get education around how that works and everything. If I look at this here, just update this. This is the employee app, which gives your team members the ability to be able to go in and see what's going on. So if I have an offer that's been sent to me, I'd go into that offer section there. I'll be able to actually see the details of the equity offer. I'll be able to go and execute the grant docs, see the plan rules, and actually accept that offer. Once I accept it, I'll be able to see all the vesting and everything here. And then the other thing I'll be able to do within the app here is access a bunch of education tools here. So what's vesting, what are stock options, and all that sort of stuff. It's really important your team understand that. And then the other thing I can do here is actually understand what's the equity grants like worth at this point in time, but then also run some scenarios on what they might be worth in the future. So if I look at this example here, I've got a value on, actually, let me just look at this one here. I've got this value on this one here of 265K. But if I actually look at, well, what happens if we got to $200 million valuation, you can see what that's going to be worth at that particular point in time. So, a lot of rich functionality for you as founders to be able to share with your team via the app so they can understand how these things work, but also to be able to actually identify with the value that you're actually generating via the employee equity grant over time as well. So yeah, this is really important in terms of, there's a technical side of setting up your ESOP and running it, and also doing the grants and everything. But the people side of it is just as important, because as I said right at the beginning of this process, while people value the equity grants and it's an important part of their decision around whether they're going to join you and whether they're going to stay with you at the end of the day, there are still a lot of employees out there who don't understand how these things work properly. And if I don't understand how they work, I can't really tap into the motivation, and I can't really tap into the full value of that at the end of the day. So that's just a brief dip into the Cake portfolio. I know we're up against time. I've still got a little bit of time, Shaq. I don't know if you've got a little bit more time. I'm happy to actually take a few more questions. That's pretty much the end.
There is a good one in the chat at the moment, Cal, again from Claudia, who's been amazing, but wondering, is ESOP really only good for companies that are going to be unicorns like Canva, or does it work for medium-sized companies as well, or the for-purpose space?
I think it works for all of them. I mean, like, people like Who Gives a Crap, run their ESOP through Cake. They're a full purpose business. Yeah, I think it's for anyone. And yeah, like, Cake is nowhere near a unicorn, but my stock incentives in Cake are actually worth quite a lot at the end of the day. And even, there are some great examples in the Australian market. People like, Upcover, who recently ran a Series A round, were able to provide a liquidity opportunity for early employees. So I don't know if you know the team at Upcover, but they had employees in Australia, in Nigeria, and in Spain who were able to take advantage of the fact that they were oversubscribed effectively for their Series A round. They were able to take some of their options and sell them down at that point in time and be able to take money out. So, it's very much, not about having to wait necessarily 15 years or until you get that unicorn status to be able to actually do that.
Yeah, we've got another one that's just popped in saying, how would employees who are overseas be treated differently, especially contractors who are from offshore locations such as Vietnam or the Philippines?
That actually ties into my final topic very nicely. So in terms of those international considerations, ultimately you'll need to be seeking tax and legal advice from the country of the relevant employee or contractor. So, for example, Vietnam, Philippines, you'd want to be engaging a law firm and an accountant over in the Philippines and Vietnam. But ultimately, you can still give them options, but because they're non-Australian residents, unfortunately, they won't be able to rely on those tax concessions. They won't receive the same benefits as Australian residents. So there is a little bit of a limitation, but you can still issue them options depending on the advice you receive in the other country. And I do have a few examples to illustrate what I mean by, the advice in the other country. So in the US, you can easily give a US citizen options in an Australian company, but in a lot of cases, you may need to set up a US sub-plan that sits under your Australian plan rules. So essentially, you have a child of the plan rules here in Australia, and then that will, of course, allow you to then give them options in the US through a tax-effective process. And in terms of India, we had an example recently where there is actually a restriction on Indian citizens from holding foreign options or options in foreign entities. So you can't give them options through Australian options through your Australian ESOP. And we had to help our client, get legal and tax advice in India, and they had to consider an alternative incentive scheme that did benefit the employees from a tax point of view and from an Australian point of view, just allowing you to give them those incentives, even though there is a little bit of a limitation.
Yeah, just on that one, we very commonly see people doing it in the US, and we've done it ourselves. So we have US team members there. So, we've got the ability to be able to help you with 409A valuation, which is something you'll need there. We understand all the mechanisms, how they work in the US. So that, non-qualified stock options, qualified stock options, RSUs, RSAs, all the instruments. So if you do have questions about that, let us know. It's generally the concessions. A lot of countries, they are available, but there will be variations on them. As I said, in the US, you need a 409A valuation. In the UK, you need a HMRC valuation, and the mechanisms are slightly different. But we can help you navigate through that process depending on what country you're in. So just to kind of wrapping up the presentation, we do have some discounts that are available, and we have some awesome resources. As Tila said in the chat there, we will share the slides from today, so they'll be sent out to you. But we also have, if you scan this QR code, you'll have access to discounts that you can use for the Cake platform. It's free for your first 5 investors. So if you're early stage, you can get on there and actually check it out and get up and running for free. But once you hit the 6 stakeholders, it'll be a paid plan. And you can get a discount on that. There are a bunch of other resources that are around ESOPs, but also around capital raising, etc., and cap table management, all in here. So check that one out.
Oh yeah, and I guess final sign off from me. Just wanted to run through the support that LegalVision can provide. So we do work with a lot of startups, right from incorporation of the company right through to their Series C raise that we did one recently. So we are very experienced with startups at all stages of that startup journey, and under our membership, we do take care of a lot of business as usual legal needs. Those are the main items that are covered under the membership, and ESOPs, for one, are covered under they're considered a business as usual legal need. So that is something that a lot of our clients do come to us for. And you can ask us questions upon questions upon questions. We can help you set it up. We can help you guide you through that entire process, from setting it up to making an offer, and then also, buying back options once an employee leaves, for example. We also can help in the situation where you end up, 5-10 years down the line, exiting the business. And what do you do with those options? Do you buy them back from employees? Do you convert them into shares and they participate? We can help with all of that. And in terms of the membership, we have this process called a legal advice consultation. They're basically 30-minute calls. You can book them in at any time through our Prism portal. And through there, you can book in as many as you want. There's no limit. If you have 1 question, if you have 10 questions, you can book it in and we'll have a chat about, ESOP-related questions.
Yeah, great. Cool. And look, just to round it out from our perspective, ESOPs are important. I think they're going to get even more important with, smaller teams with greater impact going forward. Really advise you to get it in place early on so that, you're getting the right people, and you're using it as a real tool in terms of attracting talent, but also rewarding and retaining talent from early on that process. Between people like LegalVision to help you get the docs set up and that sort of stuff, and then using the Cake platform, it doesn't need to be an onerous process or a particularly expensive one to get up and running with your ESOP. So get it done early, do it properly from day one, and then technically, yeah, there's some great attributes to it. It's very tax effective and everything, but make sure that you're also using the tools that are available, like the Cake app, but also actually talking to your team members about it as they go on their journey. So as you're going through all hands meetings and things like that, we're talking about how does our current run rate in terms of ARR relate to the valuation of the company, so people identify with what that means in terms of their equity incentives as they go on that journey when you're between funding rounds and those sort of things. So make it part of how you're actually building your team. And look, if you have any questions as you go through, jump on the Cake platform. It's really easy to sign up. It'll take you 2 minutes. You can get going for free. If you have questions and need help along the way, feel free to reach out to Taylor or myself. We'll share the slides. We're always available. So feel free to hit us up via email or via LinkedIn, and we're happy to help you navigate through the process. Thanks very much for your time, everyone. Looking forward to seeing how you all go, and feel free to reach out if we can be in help anyway as you go through this process. Thanks, Taylor. Thanks, Jack.
everyone.